Welcome to the Baker Tilly U.S. podcast, an online community developed to connect you to our partners and leaders across the globe. Subscribe today to continue discovering new and unique ways that Baker Tilly can enhance or protect your value as we discuss timely, relevant, and impactful topics. Our current series is specific to real estate professionals. We recognize that the coronavirus is affecting real estate companies and organizations across the world in unique ways. In this podcast, we will speak with Baker Tilly practice group leaders about practical real estate guidance to help you through the next several weeks and to prepare your business and employees to come back strong in the future. Let's get started.
Hello, and welcome to this week's edition of Buzz House, our Baker Tilly podcast where you can find all the buzz affecting multifamily housing. I'm Don Bernard, the partner in charge of Baker Tilly's multifamily housing practice. I'll be talking with my cohort and partner, Garrick Gibson, who also specializes in consulting on multifamily transactions around the country. As I'm sure you've seen, unemployment claims are up to 33.5 million people in the 7 weeks or so since many states enacted stay-at-home orders. The official unemployment rate is now at 14.7%. And why I give those statistics is there's obviously a lot of interest in May rent collections. We saw that April rent collections were not too bad, especially around the affordable properties. And early on, anecdotally, we're hearing that May rent collections are actually even a little bit stronger than April collections, which is obviously good around the industry. I think a lot of people are moving to how will June look, how will July look, and some of that we'll get into some of these programs we're going to talk about that are being bantered around in DC and so forth. Today in the big picture, we're going to be spending some time digging into a few items that's currently being discussed in Washington, D.C. that might be included in the next round of pandemic legislation. And we're also going to discuss a few options to consider, as we talked about last week, with tax credit equity pricing coming down a little bit. How do you make your deal more attractive for a tax credit investor? Let's start with the various proposed bills affecting housing. The first one to touch on briefly is a $75 billion housing assistance fund, which was introduced in the Senate recently by Senator Reid of Rhode Island. It would be flexible dollars that would be administered by state housing finance agencies, and the distribution formula would take into account the state's number of unemployment claims. The dollars would help to make things like mortgage payments, catch up mortgages that went into forbearance, utility payments, and other assistance to prevent defaults. This dollar amount, $75 billion, was based on mortgage assistance needed around the Great Recession that went through the hardest hit fund that was about $21,000 per mortgage. Moody's forecast that there could be up to 2 million foreclosures eventually as a result of the current economic condition. A second related bill being drafted that will be introduced by both the Senate and the House is the Emergency Rental Assistance Rental Market Stabilization Act of 2020. Wow, that's a mouthful. These bills will call for $100 billion and will be for renters that have the inability to attain or maintain housing stability or have insufficient resources for their rent, utilities, or related housing costs. These would be for renters at or below the 80% AMI level. These dollars also would run through state housing finance agencies. Although the CARES Act addresses temporary relief of eviction for tenants, households who live in rental properties not covered under the CARES Act may be unable to access a respite from these rental payments. Additionally, in prior podcasts, we've talked about the idea in the industry of pushing for the 4% tax credit percentage to be fixed at 4%. And we want to spend just a few minutes going over some of these key talking points. Garrick, give me your thoughts on kind of what is driving this, and I assume these are some talking points that our listeners can use to address their legislators as well.
Yeah, sure, Don. I got about 5 points that I think are relatively important for this. Number one, we have the credit percentage, which of course changes each month according with the federal borrowing rate. It's at an all-time low in the 3-decade-old program. With the Federal Reserve cutting borrowing rates to near zero levels in response to economic issues in light of the pandemic, the credit rate for this program in May is at 3.08%. The lowest the rate can technically fall is an even 3% unless we have negative interest rates. So we are almost as low as possible, which is, not how the program, in my mind, was designed. Second point is there are a lot of bond deals in the pipeline that assumed a higher tax credit percentage. For comparison, 12 months ago, May 2019, just a year from now, was 3.25%, and January 2020 was 3.18%. So these drops, coupled with some of the lowest equity prices we've seen in the syndication market, is creating gaps in bond deals. For a project, for instance, with $15 million of eligible basis, the drop in tax credit percentage and about 6% drop in equity pricing would probably create somewhere around a $500,000 gap with all other factors staying constant. That's quite a substantial reduction. Based on surveys for economists, on my third point, they believe the Fed is going to keep rates where they are, probably through the end of 2020, if not longer. So this means the viability of many 4% deals remains in question. So 4% lock would be great. It is actually precedence for this, as Congress enacted the 9% fixed rate for the competitive 9% low-income housing tax credit program that had dropped below 8% during the Great Recession. So that's another point to consider, the fact that there is precedence for locking that rate. So, locking the 4% rate, I think, has some legs to it. And the last point, the National Association of Home Builders estimates that for every 1,000 rental apartments developed, approximately 1,130 jobs are supported for a year. So the fixed 4% rates will also allow for thousands of additional units to be produced, helping to sustain tens and thousands of jobs. So I think if you're out there trying to push for the 4% tax credit percentage, those are some great points there that should be discussed with your Congress representative.
Those are really good points, Garrick. And one other point we discussed in the previous podcast as well, and have been discussing across the industry, is obviously along with the 4% tax credit percentage is this requirement for the 50% test, and the idea of getting that 50% test lowered. Garrick, what are some key ideas around lowering the 50% test?
Sure. I'll give you a little background first of all. So in order to obtain the 4% tax credits, at least 50% of basis must be financed with tax-exempt multifamily bonds. So with either various requirements to halt construction, slow down because of social distancing and other labor shortages, or the beginning of supply chain issues, construction delays are occurring. You're hearing it right now. I'm hearing it in the industry as well. So with these delays come increased costs, of course. So because of these unanticipated increased costs, we are seeing some projects in jeopardy of not meeting the 50% test. If you miss that 50% test, you technically miss the tax credits on the whole project. So which leads to my point. Another key item of discussing is possibly lowering the 50% test to maybe 40 or 30%. So that would free up valuable, number one, tax-exempt bond volume cap to do additional 4% tax credit projects. And the last year, we have seen states running out of their volume caps, such as Minnesota, Georgia, Texas, to name a few. The National Council of State Housing Agencies calculates that if this test is actually lowered to 25%, there could be an additional 1.4 million rental homes created over the next decade. So maybe 25% is pretty low, but even at 40 or 30, that's definitely going to create some additional benefits there.
Very powerful indeed. Yeah, I just want to touch on a few other brief points that are being discussed, as we've again touched on in previous podcasts, providing additional basis boosts for vulnerable populations impacted by COVID-19, including these tax-exempt bond deals, rural deals, Native American communities. And then also still out there on the docket, it's seeing an increase of the 9% allocation by 50% with a 2-year phase-in. The affordable housing industry is looking for all parties to continue to reach out to their legislators on these important items, in addition to issues surrounding timing deadlines. The IRS is the only federal entity yet to provide housing guidance related to the pandemic. So that is where a lot of focus is going.
Yes, it is. Matter of fact, speaking of the IRS, this is probably a good segue into development surrounding the PPP Loan Program we previously discussed. So I'll give you a little background on what I'm talking about. So the PPP Loan Program was enacted as part of the CARES Act. Including in the program is a loan forgiveness provision. Amounts eligible forgiveness are based on funds used to cover certain payroll, mortgage interest, rent and utility costs paid within 8 weeks of the loan's origination date. So in enacting this program, Congress stated the debt forgiveness shall be excluded from gross income, but they did not codify, otherwise clarify the exclusion. So recently, the IRS weighed in with guidance under Notice 2020-32. This notice is claiming that expenses paid with a loan that is later forgiven in the future are not deductible for U.S. federal income tax purposes on the basis that the cancellation of indebtedness income would not be taxable to the taxpayer pursuant to the CARES Act, which, according to the IRS, makes it wholly exempt income from tax pursuant to the code. So some ranking members in Congress were quick to disagree with the IRS's position. Senate Finance Committee Chairman Chuck Grassley issued a statement saying, the intent was to maximize small businesses' ability to maintain liquidity, retain their employees, and recover from the health crisis as quickly as possible, also adding that this notice is contrary to that intent. In addition, the House Ways and Means Committee Chairman Richard Neal said, through a spokesperson, we are planning to fix this in the next response legislation. Let's just hope they do, because to my knowledge, maybe yours too, John, no court has ever ruled that a contingent event that may or may not occur in the future tax year can somehow retroactively treat expenses that were deductible at the time they were incurred as though they are now non-deductible expenses. In the case of future contingent event is the PPP loan forgiveness. That's the event here we're talking about. So at the time the PPP loan proceeds are acquired, they're not actually considered wholly exempt income. In fact, because the loan proceeds may only be partially forgiven, logically they would be classified as partially exempt. Therefore, any expense incurred with the proceeds should technically be fully deductible. However, absent additional guidance for the time being, we recommend taxpayers plan on these expenses not being eligible for deduction unless Congress acts. While initial indications are favorable, a correction would be part of a larger legislative package that presents the usual political roadblocks. So, accordingly, we cannot predict whether Congress will take steps to clarify the intent of the CARES Act loan forgiveness provision, but we do hope they do. Currently, actually, there's a new bill in the Senate right now that's floating around, which sort of addresses this. So we got our fingers crossed.
Really good points, Garrick. We look forward to those developments, and we'll keep you on top of those here on the Buzz House. Before we wrap up, one last thing I want to get your comments and thoughts on, Garrick, are what can developers do to mitigate the current drop in investor pricing we're seeing, anywhere from maybe 6 to 10%, compared to just a short 3 or 4 months ago?
Well, Don, that's definitely an interesting question. I know we were going to talk about it. It's great to squeeze it in that last minute. But look, I actually think we have some time, and I'll briefly discuss what I've suggested to developers in this instance. So, as you know from discussions with syndicators and developers, that equity pricing has dropped roughly around 6 to 10%, depending on who you're talking to. Pricing is generally based on these after-tax returns. So, logically, any increased losses during the period, the investors in the partnership would increase the after-tax return. So noting as long as the additional losses are not causing any negative capital count issues. That being said, we are currently under bonus depreciation provisions. Therefore, increasing the amount of short life depreciable property would accelerate losses in the LifeTech investment period, thus boosting after-tax IRR and hopefully garnering better pricing. Although investors may or may not pay for the additional losses, you'll just need to discuss this with them and figure it out, if they will or not. A great way to accomplish this is with a cost segregation. Without going into too much detail, in a nutshell, a cost segregation typically performed by a qualified cost seg engineer is the process of identifying personal property and land improvement assets that are grouped with real property assets and then separating them out for tax reporting purposes. And the results are typically substantial. For instance, a cost segregation could extract $1 to $2 million from real property assets and classify as shorter life assets eligible for bonus right now. So that immediate bonus deduction is what you're looking for, right? And that boost to the after-tax return to the investor is hopefully what we're hoping is going to increase some pricing to the project. And by the way, Baker Tilly, we do have a department that performs cost segregation. So if you have any questions about them, please send us an email and we can get you connected to the right folks.
Great information, Garrick. As we wrap up today's Buzz House podcast, we want to let you know we are taking a look at the impact of COVID-19 on income levels and how that will be addressed in the 2021 HUD rent limits and how that's going to impact your underwriting. We'll be bringing this discussion to a podcast soon. Also, breaking news today at the House, the fourth round of legislation just came out being proposed called the Health and Economic Recovery Omnibus Emergency Solutions, or HEROES Act. Please look to us next week's podcast of the Buzz House to talk more about the HEROES Act proposals. Again, we talked a lot about 4% projects. If you have any questions about underwriting your deal in today's market or the potential impact of some of the legislation, please reach out to Garrick and I. And again, in general, thank you for tuning in today. And again, if you have any ideas or suggested topics, please send them to build@bakertilly.com. That's BUILD@bakertilly.com. And please check out bakertilly.com for many resources around COVID-19.
Thank you for joining us today. To receive notification when new episodes become available, please subscribe to Baker Tilly US wherever you get your podcast.